Hello and welcome to Aussie Property and Wealth. I'm your host, DilipKumar, co founder of Hallmark Buyers Agency. This podcast is about making property simple and accessible to everyday Australians can build wealth through property. Whether you're a first home buyer, just starting property investment, or an experienced property buyer, there is going to be some practical insights, some takeaways that is going to help you make smarter property decisions. In each episode, we bring together experts from the property ecosystem, mortgage brokers, accountants, property managers, industry experts to share practical insights that help you make smart and confident decisions. My personal mission is to help at least 250,000 people, about 1% of Australian population, move stronger financial position through property. Each episode is one small step towards that goal. Today, I'm honored to have Madhu as the first guest. Madhu is an experienced mortgage broker and a director of finance and mortgage solution. Many of you already may know already Madhu. She's very active in the social media and very, very active in the social groups, sharing valuable insights, supporting people. She has over 20 years experience in this landscape and she's been helping clients with simple solution, complex solutions in any shape or form. I'm really honored to have Madhu here. Madhu, welcome to the podcast. It's an honor to be my first guest.
Thank you very much, Dilip. It makes me feel very special to not only be able to work with you, someone who's passionate and someone who's also had a lived experience of being in this country and understanding what you are doing now. And for me, I have always looked forward to working within the community because I'm very passionate about working with people who are actually trying to uplift the people around us.
Absolutely, Madhu. I think there is a lot of synergy. From our first conversation, we've had a lot of synergy. And since then, we have done so much work together. I'm really honored to have you on this show. Today, what we want to do is talk about property financing that really works in Australia. From want to talk about things that matters to first home buyers, be it investors, how to structure the loan, what could be the simple habits that they could do, and make sure that they are helping themselves to get towards their property goals and finance goals and everything, right? I want to start off with something lighter. I would say wanted to understand your personal journey, Madhu. I know personally how much work you do within the space and slightly outside of the space, helping people around. What really led to you into mortgage brokering? Understanding you have a completely different background before coming into mortgage brokering.
I actually graduated from School of Planning and Architecture in New Delhi in 1990, and I came to Australia immediately as a
Hmm.
young married migrant woman.
Okay.
Australia was into deep recession of the 1990s. For this generation who's not familiar, maybe you can go online and check. Interest rates were about 12 to 18%, and slowly as a new migrant, I arrived with a lot of ambition and also with uncertainty in starting life as a newly married person, but also in a new country, new financial system, new credit rules, and new opportunities. So I started looking for, finding people who looked and understood my background. I was extremely lucky. I got a job within a week with one of the top architectural firms, Johnson and Johnson, and they have actually done the master plan for Homebush Bay, which is now the Olympic Park, and also the big Darling Harbour. So
Okay.
we basically did not understand anything to do with finances. However, in my day to day life, I was meeting a lot of migrants, early migrants in the 90s, who
Mm-hmm.
were not really getting good jobs. And for me to see the impact of families and children where parents were not working for many years
Mm-hmm.
led me to a very deep understanding that the money and the wealth of a family impacts the next generation deeply.
Mm-hmm.
So, extremely lucky to then join FAI Property, which was the property development arm of FAI Insurance, which was listed in the stock exchange. There, my journey in finance began, and I basically became the national head of FAI Property because of my background in architecture.
Mm-hmm.
My finance mentor is Mr. Avi Rubenstein, who was the CEO of FAI Property. He himself was a migrant from South Africa, and He gave me really all the opportunities that I could have ever wished for, understanding the sales. Remember, the recession was still there.
Yeah.
Nothing, no property was selling. Interest rates had now dropped to about 12%. People were not familiar with off the plan sales. But
Mm,
what he did teach me was the basic system of how
mm,
money works in Australia. How do we do developments? What are the interest rates, and what should be the return on projects? How do people buy property? And he told me about going down to the local Commonwealth Bank in North Sydney and understanding how much I can borrow, because he said if you have a good job,
mm,
and it was something which is completely new to someone growing up in India, where, this is not really a topic as a young person in the family you get to hear or are exposed to. And what I realized very quickly is that property ownership is one of the biggest wealth builders in Australia. But the
absolutely.
financing system can be confusing, especially
Yeah.
for migrants or professionals who don't grow up understanding it. So it was very auspicious, I should say, that AFG was next door on the same floor. And they
Mm,
came to me saying that if you guys are selling properties, we will do the loans. So my journey with mortgage broking started very early with my career in Australia. And like I said, it also brought me to a understanding that I can combine two things. I care
mm,
deeply about finance and helping families build stability. And I also understand that I can build wealth for myself.
mm,
Having a stable job, and you can get the rent to pay for it. Depreciation is a big part of, getting interest in investment properties to work for your cash flow purposes.
mm, mm,
And coming to a new country and making this country home was also very much a part of finding a meaning and a reason to do the work that I did.
mm,
Over the years, I've helped many first home buyers, migrants, professionals, and investors structure their finances in a way that protects their future. And I, in my 29 years of my career, have had very good, successful clients. I've basically impacted their journey and their family's journey to be able to grow and take risks in the second generation, which has given me a great sense of satisfaction. I've also mentored several brokers. I've also worked as someone who's done the financing for the Gurdwara in Parkley in
okay.
2006. I have been deeply involved with the Vedanta Center, which is the Ramakrishna Mission in
Mm,
Australia since 2001,
mm,
building their portfolio and making sure that we build a place for the migrants to congregate and meet other families, as new migrants need to do that to build their future and understanding. And I think understanding that the story of financing is very much around the community that you are actually traveling with. And that is probably the greatest message, if I can actually talk to anybody, is
mm,
that
mm,
the work or the outcome that we do as professionals is very, very important. But I think the mindset or the ability to get through the difficult and the positive phases in one's life comes from the community that we are surrounded with, the people we interact with. And when you get the keys to your home and you have a property portfolio, the comfort, the security, and the outlook of life and the health impact is really, really tangible. That's a little bit about my background and why I still want to do mortgage broking after 30.
that's phenomenal, phenomenal journey. Though, like I can relate to so many things that you're talking about it, especially on how you relate that mindset to the culture background of how we want to do. Because I see community as a shared identity. We have a common set of beliefs, values, and everything. And when we moving from one place to other place, sometimes we take a little bit of time to get our foothold and everything. Thank you for all the work that you do, Madhu. I want to start with a very, very interesting question. It's about that everybody probably many people are asking you, right? The interest rate is going to go up, down, or going to be staying the same. What is your opinion?
I think with every war comes a scarcity of the logistics of day to day items, especially Australia probably imports a lot of those
Mm,
items.
mm,
And also, I think war also creates a sense of potential problems, which may or may not actually eventuate for us in Australia. We live in a very safe economy and a very safe country. We're actually growing and we're not expecting any direct impact in the inflation. However, the global inflation will probably impact, and we may have one rate rise and maybe potentially two. That's the only lever we have to control the inflation. However, I think the government is also looking into certain key changes, bringing in capital gains tax and so forth, which may cool the transactions in the property market. So the second inflation impact of a rate rise may or may not happen. I see in 2026 we may have a rate rise, but I feel in 2027, with the impact of war being almost a year old by then, would actually start bringing the interest rates down, because by then Australia may actually start to feel the impact because it's not instant, but it may happen over the next 12 months.
Okay, okay, that's interesting insight. Like, connecting to the global events to what's happening in the country. So, is it time for people to fix the mortgage, or like keep it variable and see how things play out for next year or so?
I am probably a contrarian about interest rates.
Yeah.
I think we should be looking at our own life cycle and not
Right.
basically looking at what is happening and reacting.
Mm-hmm.
If you are a young person and if you have certain amount of fixed income, interest rates at a fixed rate may give you peace of mind. But I would
Mm-hmm.
never say that you fix all of your loan. I
Yeah.
would go 50-50,
Mm.
because the impact that every dollar has on a variable rate is far greater than a fixed rate. And over the lifetime, fixed rates have shown not to reduce the term impact as much as variables do.
Mm-hmm.
And historically, what we see is that the property markets adjust faster than the interest rates. So when the interest rates drop, buyer demand usually increases. So waiting purely for interest rates to fall can sometimes mean paying more for the property itself.
Absolutely, absolutely. That's a very interesting response you have given, connecting it to people's personal life. And I'm a firm believer that, like, what is out there and the best may not be the best for you. You should always pick, like, what is going to suit for you, and work out the right strategies to implement. Right. That's a
I
great answer.
always ask that, can you afford the loan comfortably today?
Yeah.
And that's from where you start your transaction of buying. And when you're buying, I think that all you have to do is think that, are you a 30-year-old or 20-year-old or a 50-year-old, and what does your life look like? We don't
Mm,
know, but we should always take the best decision based on today's circumstances and variables,
mm.
not overthink it or not look back in what the economy did. I think just from where you are, making the best decision is the wisest.
Absolutely. I think, like, the part about overthinking, right? I think people tend to go into this mode of, like, analyzing too many variables, sometimes, like, not keeping it simple. So I think, when the key part, like, experts like you play is, like, providing that clarity, right? Focus on these. This is what is important. I think that is where I find personally, when I'm working with many different professionals, the clarity that they're able to give is the biggest value add that we can provide to the clients.
Three things really matter at any time approaching any property decisions when rates
Mhm.
are uncertain. Is stable income. Where is your income coming from? It could be from your, second job, or it could be from your PAYG.
Mm,
Comfortable repayments.
mm,
Don't stretch yourself. There should be enough so that you can still go for the movies and have that popcorn, rather than saying that everything is going into your mortgage. And having a financial buffer.
mm.
Financial buffer can be 2 to 3 months worth of repayments and home expenses. Find yourself a good budget. That's a very good place to start. And
Mm.
properties are usually a 10 to 20-year decision. It's not
Right.
a 6-month decision.
All right. Thank you. Thank you for providing that insight. I think that the three steps that you have said, like, that definitely gives people some structure to think about and everything. And now a classic question I hear a lot, right? Be it a first home buyer or, like, investors. Should we go to the bank that I'm always going to, or should I go to a mortgage broker? Now, what really is the big difference? how do you tackle that such questions, or like, how do you provide that clarity back to your clients?
I'm extremely lucky because when I started, the word mortgage broker was not even a word people wanted to hear about.
Mm-hmm.
Banks used to say, we will give you better rates, we
Mm,
will help you. But I always knew that in the migrant market, people did not have 20% those days. I'm talking.
mm, mm,
And I was one of the very early mortgage brokers who would talk to the banks and
mhm,
say that, look, we need something which allows a person to come into the market earlier because we can repay the mortgage because we are paying rent.
mm,
I
mm,
understood that. And I think that we as mortgage brokers have been great, means of change that the banks have actually done for the wider community because we know the personal story. We know that a person is also supporting their mother back in India. We
mm,
also know that their wives are looking after their children at home. It's a single income. We
mm,
know that that will change. We know that. The situation that one is in today, earning 100,000 or 80,000, will change if you are a person who's just graduated and got their first job. I think a bank does not understand and is not interested in your journey in life. They're
mm,
not interested in your facts and figures are the only things that they see. You are a male who's 30 years old, has a job, married, you've got a credit card, you've got a car loan. But we go beyond that. We go,
mm,
what is the person's actual ability to repay?
mm,
Maybe they don't pay 6,000 in living costs. Maybe they live very comfortably,
mm,
and
mm, mm,
maybe they live sharing with their parents, and their cost is literally $500, but the bank would never accept it.
mm,
And I
mm, mm,
understand that, banks have put some guard rails to sort of, apply to more average people in different circumstances. But a broker is like, you having your own accountant versus you going to uh, do your taxes here and the next year you go somewhere else. That person doesn't know enough about
right.
your finances to give you any tax advice or tax benefits for the next foreseeable future. So I think a broker is very much a part of your journey, and he is probably a very much a trusted advisor because he knows your health condition, he knows
Mm,
your financial condition, he knows your job opportunities, he knows your job problems. We have actually lived through the COVID very
mm,
successfully, making sure all our clients are actually able to deal with any changes of people losing jobs
mm,
overnight.
mm,
So I think for us now, I'm not talking about myself because I've been, a broker for all of that journey of nearly 30 years when brokers have now become a legitimate
true.
career. But I think that banks and the community recognize that a broker is a very valuable input, even though you may know enough about what you want.
Mm,
Going
mm,
to a broker gives you a lot of opportunities where there is none and you feel you don't have a deposit. We
mm,
can give you 100% deposit.
mm, mm,
Whether you wait for your car loan to come through now, we may give you that advice saying, let's do the home and then you
mm,
can buy the car.
mm.
It can be very simple. It sounds very simple, but it deeply impacts the financial journey of how and when the client actually grows their wealth.
That's phenomenal. I think this is much beyond the traditional wisdom of where people say, like, when you walk to a bank, you're just getting access to all of their product, whatever banks have to offer. Now you're talking about, and like, generally people think you go to a mortgage broker, they may have a panel of 50, 60, so more solutions could be available. You're more looking at the human side of things and what journey that they're going to go through, and helping having that relationship is going to take the clients taken care of on the longer run. As you said, property is not a short term, 6 months, 12 months thing. No, it's a long term. So it's always better to have that, good relationship, trusted partners on your side. So
And
that's
also think a bank can only offer their own products.
correct.
And they don't different lenders assess income, rental income, and self-employed borrowers differently, and that's
Mm,
where the brokers add real value. I mean,
mm,
you could be a contractor and some bank will take all of your income, and some
mm,
banks will use it as a 48-week income, and it makes a
mm.
big difference.
Mm. The same thing could apply to bonus and like all the other things, isn't it?
Yeah,
Commissions.
they're shaded. Even rental income.
Yeah.
Some banks take 90%, some banks take 80%.
Yeah.
So just finding that sweet spot, which is the ideal outcome for the
Mm.
client's journey, is
Mm.
where the broker can be invaluable.
Excellent. Thank you. Thank you for providing that clarity, Miku. I want to touch a little bit about first home buyers, right? There's first home buyers are on news. Everybody seems to be struggling to get into the market, and I feel that first home buyers, in terms of property journey, need the most help because of doing it for the first time. Pretty much like many of them are young. So, what do you think that the first home buyers are making as a common mistakes or the patterns that you have seen when they're trying to get a loan?
Let me tell you a story which you also been a part of,
Mm-hmm.
and it will actually help people understand the difference.
Right.
Let's call, I have two first home buyer clients. One is called Sanjay and one is called Hari.
Mm.
Sanjay is a more matured person. He's in his early and his daughter goes to high school. And Hari is a young, first home buyer with a decent enough jobs. Both of them make very similar money,
Mm.
and he's also got a young child, and his
Mm.
wife
Mm.
works. And we see that Sanjay has been in this country for more than 7 years.
Mm.
He's very happy. He's got a big deposit of $110,000. That's after paying rent for almost 7 years at whatever the market rate is. So you can see the amount of money he has invested into paying rent.
Mm.
Hari, on the other side, has come in a few years ago. He's just got his visa in April of 2025. By December of 2025, he came to us and he had $30,000.
Mm.
Sanjay has not found an ideal property. He's
Mhm.
still looking for that ideal property, which is near his daughter's school. It's convenient for his wife to catch the public transport. Whereas Hari said, okay, you know what? I work in IT. I'm going to go and buy in Queensland and I'm going to move.
Mm. Mm.
The difference in the outcome of the two first home buyers is enormous. Hari today is sitting on a 30K uplift on the value of the property he's already bought. So
Yeah.
he's recovered pretty much all of the 30,000 that he had put. And Sanjay is still looking for his ideal property. We have given Sanjay the pre-approval and the pre-approval has expired. After that, he spent another 3 months looking in Melbourne for a property. He lives in Sydney and he's still not made up his mind where he will finally go and live. So he is someone who's thinking that he's not ready. The
Mm.
biggest mistake a first home buyer makes is not preparing early enough and not having an understanding of what is the meaning of the budget and where the money is going and understanding what happens if he changes the rent into
Mm.
a mortgage so that in 10 or 15 years time closer to retirement it'll be a very manageable mortgage if he has some consulting work or he
Mm.
moves away from a 40-hour week work, right? So it's really only about the mindset. It is not what people are saying that it is really hard. It's looking at opportunities, like I keep saying. Don't look back and don't look too far ahead. Look at what you can do. The present is the present. So, what three things should the first home buyers do early? Maintain a clean credit history, reduce unnecessary debts like credit cards or personal loans. I
Mm.
think a lot of people fall into the trap of coming to a new country, getting a credit card, buying a car, and all of that, and they feel that now I'm paying rent, I'm paying all these car loans and all that. I'm not able to save, therefore I'm unable to buy a home. Building genuine savings, like I said, even if you get 100% home loan, building genuine savings is a must. It is
Mm.
what gives you an understanding that you can manage this. It's like going from being a single person to now getting married and thinking about two people. Same thing. When you
Mm.
have a
Mm.
home loan, you need to make sure that it's just a replacement in your life as an expense instead of just a car loan. It is now a mortgage, which will actually give you a roof over your head when you retire. I think that is a vision that you do need to think as a first home buyer, that you need to get to that journey. You don't have
Mm.
to begin there.
Excellent. Excellent. Can we unpack a little bit? I think you gave a lot of valuable inputs back to the first time buyers what they should do and what they shouldn't be focusing on. You mentioned something about maintaining a clean credit history or a credit score, right? For many people, that's a little bit abstract. What is that? What are the things that they're doing that is negatively impacting that credit score, and how do they even check it? Can you unpack that topic a little bit, Madhu?
Sure. Banks basically want to give loans to everybody. The only reason they're unable to give you a loan is if you have financial commitments where most of your money is diverted
Mm-hmm.
for reducing the net savings left to pay a mortgage. So looking at your total financial commitments is like you may have an afterpay, which is like buy now, pay later, credit cards, or even HEX in some young people situation. People have a habit of saying, I'm going from one credit card and I have an interest free period of 12 months. So after a few months or a year or so, they go to apply for another credit card.
Mm-hmm.
And instead of having paid that balance off, they move that balance to another credit card. Afterpay is beyond your budget and you are actually living, say, on a $5,000 month budget, but
Mm-hmm.
you have an afterpay which is always at $2,000. It is never paid off. So this financial scoring is actually reflected now with what we have is a open banking. So now not only the bank that you deal with, but all the other banks in Australia can actually see because they share the data. So the
Mm-hmm.
clean credit history is paying all your credit cards, afterpay, everything, including your phone bill and water bill or whatever, is on time and is paid in full. So that shows to someone that you have got a very clean credit history. What you're supposed to pay is basically aligned to your repayment method. You have your discipline, you're not missing the credit card repayment. You can't say things like, money was lying in my account, but, I was overseas. All that now in the digital world is no longer acceptable.
Mm,
So I think the clean credit history is making a habit of being disciplined, that if you have even the rent is paid on time and paid in full,
mm,
that
mm.
is called a commitment, and that is where the clean credit history is rewarded. You can then get that 100% home loan.
Excellent, excellent. Thank you for giving that clarity. Can somebody, if somebody listening to this one, if they want to check their own credit history or credit score, how do they do it?
There is a company in Australia called Equifax.
Mm-hmm.
You can put the link after this.
Sure.
I mean, there are a lot of places where people think that they are actually checking their credit score, but that credit score is not correct.
Okay.
And that is actually tapping their data into their system so that they can contact you later.
Yeah.
So I would really recommend that you just go directly to Equifax
Mm-hmm.
and you can get your credit score for free. You have to just wait for 2 days. They
Mm-hmm.
email it to you. And I think you'll get the real credit score because that is a real credit score that people uh, are using at the banks. I had a client who came to me saying, when I told him that his credit score was below 700, that is something for your listeners to know, that minimum credit score of 700 is where the banks will entertain you for a home loan.
Okay. Yeah.
And if it is less than that, and you go on apps like saying, oh, my Commonwealth Bank app is saying it is 760 or whatever, and after the 21st of March, it will go up by another 50. But that is not the case. The
Okay.
Equifax score is the real score.
And for someone who may not be doing some no financial transaction, especially stay at home mom or at home dads who may not have a credit card on their name, or maybe they don't have too much of bills or financial transactions really happening on their name, do they also have a credit score built on the back end, or do they need to actively do some transactions to build those credit scores?
I really encourage everybody to have a credit rating
Mm,
because when you want a home loan or a business loan or a car loan, if you don't exist in the system, you actually are one of two people.
mm,
One who's potentially has had problems, they've changed their names, or you don't have any money to do any transactions.
yeah.
So either or, you're not their ideal customer.
Okay. So it makes sense, everybody does some financial transactions on their name and keep tracks of that. That's a
Yeah, you
good.
can be a second card holder.
Yeah.
to the main card, and you use the credit card and ensure that the card is getting paid properly and on time.
Okay. Can we touch a little bit on the hex debt? I've heard few things, but I'm not clarified this. Maybe it's an opportunity for me to clarify. Is it true that different banks or financial institution treat hex debt differently,
Yes.
especially somebody who's in the early years or so, looking to buy their first home? One of the big challenge they have is they're not able to get enough loan because of the big hex debt, right? How do they tackle it?
We know that Australia is a lucky country, and all of our children can go to very good universities, and government gives you the education loan. So the HEX debt is basically that loan which the government gives you to study
Mhm.
post your high school in universities. For people who don't have HEX, it's basically an understanding. The HEX also has inflation built into it every year on year. So if you're not actively paying and actively working, HEX debt can actually increase. It can compound. The inflation is added at the beginning of June every year when the government has declared the inflation rate, and HEX is directly debited by your employer and given directly to the ATO towards
Mm.
repayment of the HEX debt. So because it's directly debited from your employer, your net take home salary is actually reduced. So you could be earning 90,000, and without a HEX debt, you will, possibly get 30% deduction for the tax, but the balance is given to you in your bank account for you
Mm.
to
Mm.
use. What HEX does is after the 30%, you then have to give a percentage depending on your income slab, which also goes towards repayment of your education debt. So it affects the net income calculations, right? But now in the last year, government actually talked to a couple of the banks, and some of the banks actually are not taking the HEX if the balance of the HEX will be paid off in the next 5 years.
Okay.
Otherwise, if it's going to still continue, depending on the amount, 60, 70,000, it's not going to get paid off in 5 years. If it's like $10,000,
Mm. Mm. Mm.
not consider it as a liability in our calculations.
Okay, okay, that's good to know. So there are some solutions depending on people's situation, and I believe there are options where the parents or somebody else also can act as a guarantor, right? If the young Australians are not able to get the required loan, there are some solutions that are available to Madhu.
So are you saying that they borrow the money in joint with their parents, or they
So,
use
sort
their
of, sort
equity?
of. I've heard situations where they say parents are acting as a guarantor, enabling them to take the loan to buy their first homes and stuff. I've never really tried to understand how that exactly works.
Okay. For parental guarantee, there are two. One is their property is used as a security. So let's
Okay.
say the person who has a HEX debt has not been able to save a lot of money, but
Mm,
can actually afford the loan. He stays
mm,
at home and he can buy a property which is used for rental income investment.
mhm,
He can actually get his parents' home as an additional security to the new property that he's buying, and he can get 105% loan provided he can service that loan.
mm,
100% for no deposit, and
mhm.
the 5% will go towards your stamp duty and expenses.
Okay.
So that is the way the parental guarantee works.
Yeah.
If you want and your income is less, one of the parents who are, earning quite well can step in and you can have a joint loan
Uh-huh.
parent, but that's like
Mhm,
with anybody. You can
mm,
buy with a friend, you can
mm,
buy with your partner, you can buy with your wife, you can buy without your wife, and same applies for, in some cases, women may actually be earning a little bit more, and I'm seeing more of that come through.
mm,
And it's easy because of land tax and structuring. You
mm,
advise them that if you guys are buying two properties, buy one in your name and buy one in his name. So it's not just the guarantee and the amount of loan, it is also the structure, what is appropriate for the future.
Okay, that's a very valuable insights. Thank you, Madhu, for that. Now I want to shift the focus from a little bit from first home buyers to investors, right? Obviously, anyone who's bought their first home, maybe 6 months, 1 year, starts thinking about it, right? Maybe the property has grown a little bit. Start thinking of, okay, should we start thinking of no property investment and look to build a portfolio? Is it too different from a lending perspective? going for a first home versus a investor type loan, right? Now, how do you see that? What's the main difference when people are approaching for their first investment property?
Let's talk about the value of the property and the value of the loan that one can
Hmm.
afford. So let's say I'm earning about 120,000. If I was to buy a owner occupied home, I would potentially get say 480 as a loan, right?
Hmm.
Because now I'm directly going from the rent changing into a mortgage.
Yeah.
Financing for investors is different because from first time buyers, because investors are assessed slightly differently because of the rental income being included. So it's almost that another income gets added for an investor. And also, you think that you're getting 100% of the rent as income, but that is not the case.
Hmm.
Because lenders usually use something called rent shading because they say that you may have some vacancy, you may have to do some repairs, all that is included in the total income of the rent. So rent shading is where the bank is only using 70 to 80% of the rental income
Hmm.
to calculate borrowing capacity. So, like I said, it's to account for vacancy periods and property expenses. So, for a $500 rent coming in, bank will say 350 or 400 in servicing calculations. But
Okay.
to answer your question, if you can't find a house in that 480 plus your savings, you will then be better off doing something rather than nothing, is to
Okay.
do investing, that
Yeah.
you go and stay in the rented accommodation or at home, whatever the situation is, but you buy something for 500, 550 with your same budget in an investment situation, and
Yeah.
then you also get something which is a double benefit if you do that. Also get something the government has still kept, which is negative gearing, which also increases the borrowing capacity. The tax depreciation or benefit is there, and the negative gearing helps your tax position.
Hmm.
They don't increase the borrowing capacity.
Okay.
It increases your actual cash flow and income stability.
Okay. That's actually very interesting. Probably a myth people have when they are getting properties which give them higher depreciation benefits. The cash flow is good. I think invariably they start assuming that the borrowing power also goes up. So it looks like when borrowing power is calculated from an investment property, it's purely the rent that is factored in, not really the depreciation benefits or the negative gearing or anything of that sort. Yeah.
No, it is income plus rent, which is
Yeah.
used for our lending purposes.
Okay, okay, that makes sense. That makes sense. Now, there is always this, question of people hitting their borrowing limit, right? And for example, a couple making about 150 each, 300,000 per year, whatever it is, they are going to have 1.5 mil, 2 mil, whatever it is, it's going to be a higher limit. To get past that, people start thinking, can we buy in terms of trust and companies and everything? How do you see that? Do you see the lending from a trust and a company very, very different to, let's say, buying on a personal name, investment property, especially somebody with an ambition of building a good size property portfolio? What do you see that?
I'll share another story. This is about one of my clients. It's really seeing, where is your trajectory of income coming from? What does it look like before we start talking about the different structures?
Mm-hmm.
But understanding the structure is very, very important. So I'll give you an example, and it's very memorable for me. Very early on, he's still my client for the last 15 years. His name is Ali. He was a migrant from Iran,
Mm-hmm.
and he started an air conditioning company with a business partner. And I was called in to say, okay, we're doing very well. We want to buy a home.
Mm-hmm.
But in that period where we were waiting for their tax returns to be done, I got to know, you know, that the business was structured as a company
Mm-hmm.
and they were not taking any PAYG wages. They were taking income at the end of the year as directors' wages, right? And I started to also detect that there was some dissent happening between the two partners.
Mm-hmm.
So the person who started the conversation to buy his home, even though he was a first home buyer, I actually suggested setting up a trust structure.
Mm, mm,
This is even when he was a first home buyer.
mm,
At the
mm,
time, it seemed like a small structural decision, but a few years later, the partnership dissolved.
mm.
But because the assets and income were structured correctly, Ali was able to retain the wealth created
Okay.
during that partnership and protect his position. And he has a substantial portfolio which has grown, and he lives in y-
Mm, mm,
land tax and structuring and all that with every non-individual entity. So
mm,
understanding what is a right structure and why you want that structure is very,
mm,
very important. And
mm,
it was something that the structure essentially saved years of work and income. Otherwise, if it was named in the same company and he was getting wages from that company and he had the property, say, in his own name, when the partnership dissolved and there was legal problem, it would have been pulled into the pool of assets for the division.
mm, mm.
So financial structure matters as much as the loan itself. Sorry to go in such a roundabout
No,
way.
no, no. I think this is really helpful. See, I think what I'm getting is there is more people more to what people are generally thinking, they're just thinking about especially from people I speak with, when they think of trusting everything is okay, I'm able to get extend my borrowing power. That's just one element of it, but you're able to bring in many different aspects that people need to consider, because these are big financial decisions. It's going to have an holistic impact. Your approach has been from all the questions that I've answered is you're always looking at it as a holistic solution, a 360 degree. So that is really valuable. But
What is
please continue.
sustainable? What is
Yeah,
sustainable in your life? If
correct.
you're spending your valuable years and your income and your effort in
Mm,
creating wealth,
mm,
you don't want to give yourself any even 1% chance of that structure failing down the
mm,
road, right?
mm, mm,
So give you example about, yes, everybody knows that you can form 10 unit trusts and buy property in each one of them.
mhm,
But is each one of those trusts actually negatively geared,
mhm,
or is it actually breaking even? And unless and until you hear families around the world who are the top 10 families, they have family trusts and all those kind
mm,
of things. But
mm,
there is a reason for actually creating a trust. Yes, you can actually buy and you can actually hold a lot more than what you will do in your individual names. But also remember that every time you have an entity, whether it is a company or a trust, we will be paying, or we will have land tax liabilities after a
right.
certain while if
Mm,
the property hits the state's
threshold.
recognized threshold. So different states have actually got different threshold.
Mm,
It's not same across Australia. Understanding what else, yes, you are saving money in terms of taxes and all. Trust is a great structure to do that
mhm,
because it's almost like the same company structure rather than individual tax. However, is it something that you can sustain in the long term if
mm,
it is continuing to be a negative cash flow?
mm, mm, mm.
Number one. Number two, do you want to give it as a wealth for the next generation? When you are having trust, do you have enough beneficiaries to distribute that, or is it still just you and your wife? Then the income is directly coming. The trust has to distribute to the beneficiaries of the trust. So understanding the long game of the trust is very important. I think understanding a case by case is a very good thing. However, I can actually say one thing that everybody should be doing, which is SMSF lending.
Absolutely.
You can do anybody can do SMSF lending because we will all live longer, at least till the 90s, and you will probably start retiring in your 60s. So the 30-year window that you have,
Mm.
your SMSF trust can actually really be powerful.
That's actually that kind of nicely takes me to the next area. Do you see a pattern of more people buying properties under SMSF?
Yes.
Yeah. Okay. Why do you think have they suddenly started realizing the value of buying something, a property under SMSF versus the traditional investments, industry super fund? Are you seeing a big difference shift there?
I think post COVID, I'm seeing the boom in SMSF lending
Mm-hmm.
because I think during COVID, a lot of people actually got heart attacks when they saw their Australian super, going down by 30%, 40%, and not understanding why it has happened because there's no clarity in our superannuation system. If you are with any superannuation which is listed as the industry super, you can ask them that, do I have any Woolworth share? They will never be able to tell you. So you don't know where and how your money is actually invested. It doesn't have any transparency. So I think a lot of people started realizing that, hey, I can actually not have enough money when I actually retire, leaving the money there. My return is 2.75, percent or 5%. What can I do to, you know, make it a little bit better for myself? We all know that if you take responsibility, you always get better results. So SMSF lending has become something that is front of mind for everybody, also for two reasons. One, that the industry super was not performing to our expectation of 7 to 10% minimum, and at least it should be hitting 12 to 15% ideally, so that it can actually compound in your working life. The other really hidden gem in SMSF is your tax structure. The tax structure, if you're doing a project in your SMSF, you buy a property which goes up in value about 30, 40%, as we've seen during the COVID time. You can actually sell, and the capital gain there is at 15%, and it because of the holding of 1 year, it goes down to almost 10%.
Correct.
I think that is the gem in the SMSF lending. Also is a great way of reducing your tax. Government gives from July, you'll be about to pay 32,500, for which you get direct concession for your tax. And now currently it is at 30,000 per year. So if you are able to save, it gives you the same impact as a negative gearing plus more. Because even if it's negative gearing, the SMSF 30,000 or 32,000 per year is a big chunk of bringing you into the lower tax bracket in your taxable income.
Yeah, I think SMSF is a really or super using is it's a really great vehicle. I find two common challenges that I encourage every of my clients and people I speak with to tackle. Right, first thing is the income tax that they are paying out of their pay slip. Treat that as an expense. Take a look at how much they are paying month on month. Very very important. I think we go around like trying to save $100, $200 in grocery bills and insurance, but don't even look at how much we are paying, right? Second thing is super. Whether super is like self-funded super fund or something, look at how it is performing. Have an habit of looking at it, say every quarter or 6 months to see what it is and have chat with the right professionals to do something about it. I feel I know you talk a lot about having the right financial habits and everything, right? If you don't even look at what is happening, the possibility of change is you're not even giving yourself the possibility of change and improvement. I think people should start doing that, right? Look at how much income tax you're paying. Look at how your super is performing. See what you can do about it. Talk with the right professionals and see if the right solutions could be implemented, right?
I think everybody knows that it is not the people who are earning the most who are wealthy. It is the people who keep the most are the wealthy
Abs-
people.
Absolutely, absolutely. Right. Now we have covered things that first home buyers should do, investors should do, and we have kind of went into trust and SMSF, right? Are there any common themes or patterns that you're seeing that the investors are doing, which is not helping them progress their property portfolio, right? From working with many different clients or people who approach you for the first time, do you see a pattern in things that they do, maybe not the best thing?
I will come back to the first start of my conversation, that you get your knowledge from the people you surround yourself with. And this FOMO of my property is grown double, it's earning 20% every year on year, is the reason why a lot of people are actually exiting the market
Mm-hmm.
sooner than they think that they should. And
Mm,
then they have regret. Like you have buyer's remorse, you also have a seller's remorse.
100%.
So, taking a calculated risk and setting yourself goals is the best way to managing a portfolio. Not
Mm,
because the market has gone up 30% or the
mm,
market is falling. It's the same thing happens in the share market. There's no difference between the property and share, except that
mm,
ours is a little bit slower in the property market, and
mm,
it's a quicker response in the stocks and shares. Having an understanding, a deeper understanding of why you're doing something, like you could have a first home buyer buy a small villa, which
mhm,
is not ideal, and
mhm,
that's not their dream home, but starting there is sometimes not desirable. People end up waiting, and then they end up getting maxed out of that particular market. So
mm,
then they
mm,
end up being long time renters. I see that all the time. The
mm,
other thing that I see a lot of is that people will start doing a business,
mm,
and then they say that, you know what, I'm starting this business. Instead of putting the property as a deposit, let's start the business as a deposit. We will
mhm,
have this amazing cash flow, and then we will buy the house.
mm,
I see that happening so many times for long term renters. They've lost their deposit. They are not able to build it back soon, quick enough.
mm,
And the fourth thing that I see a lot of is that if somebody is buying near the airport, people are buying in Gregory Hills,
mhm,
they're going to go and just buy the land.
mhm,
You may not have the affordability to hold on to the land and
mm,
then pay the rent as well. And that is a situation you're stuck with the land. You're now not able to get even tax deduction. Land does not
mm,
give any tax
right.
deduction. And then you end up selling the land and you're still sitting in the apartment that you were in.
Mm, mm,
Understanding the big picture and understanding what you can and can't do today. If you can't buy your home, that's fine. Can you buy an SMSF? Because you stopped working, you still have some amount of money, and the
mm,
rental in the super is actually good enough for the property to grow. So not
mm,
everybody needs to have millions of dollars, but
mm,
starting from somewhere is very, very important. I think
mm,
people have this vision that I want to drive a Tesla car, so I'm not going to buy a Toyota old car, is where the thinking lies. That ideal outcome of where I see myself, this is what my other friends have done, I should be able to do it, does not apply to everybody.
yeah, I think peer pressure is a big drive.
Get away from that. Sing your own song. I can tell a story of a very successful study of one of my clients, one of my
Mhm,
early clients. She was a university professor when I first met her at the Western University, and she said, "No, I have the money for deposit, single
mhm,
lady, but I don't want to use everything in my first home. I'm going to use all the government benefits and I will keep the money."
mm,
Wonderful. Bought an apartment in Blacktown. Over every 2, 3 years, we would buy an investment property. Her university super was like 19%.
mm,
So she kept contributing in on top of, she was not getting that much of tax benefit, but
mhm,
she said that, look, I'm single, I don't have a family. I want to make sure that my old age is, very comfortable.
taken care of.
So she also chose an early retirement. So within 50 years, she basically chose early retirement. But I have been working with her from like literally her late 30s. In that 20 years, she had built a very substantial super.
Mm,
We chose an early retirement. It was very well thought of. We used both the strategies together of the property portfolio and her super.
mm,
She withdrew the funds from super, and she since her retirement in the last 5 years, she has built and sold two houses. So she
oh,
bought
nice.
and yeah, we basically had the cash in super to
Mm,
build houses, and
mm,
you can't get loan if you're doing construction in super. But
correct.
these are things that we had thought what we
Mm,
would like to do, so
mm,
that the rental income from her investment properties. So we never sold her property portfolio. This all
mhm,
happened from her super,
mm,
that we bought and sold two houses and increased it. And from the properties that she holds, her income is roughly equal to the after tax income she earned as a professor.
mm, mm, mm.
So the
Okay.
power of long term planning
Yeah.
is always starting now, and I think the most important thing is understanding what you need for you to be comfortable.
Mm,
Many people have to look after their children, and some people have to look after a grown up child in many cases. So it's not an ideal situation for everybody, but understanding that what makes you be in a position which makes you feel safe,
mm, mm,
secure in the long run is what you should aim for.
mm, mm,
And there are many steps you can take to get there. You don't have to take those humongous risks and just work with whatever you need to work. A lot of people, they don't want to work beyond 40, 30 hours, and they will not take those jobs which actually force you to do that. But on the flip side, I've also seen, couples where the wife goes and does some work later on in the evening. She's a
mm,
nurse. She only does night shifts. And during
mm,
the day, she's at home. So there is two income coming in, but
mm,
it is what the family has chosen to be
mm.
with kids or something like that. But it's also that her profession allows that kind of thing to happen.
Thank you, Madhu. I think this whole chat has been very, very enriching. Like you've given us so many golden nuggets. We are almost towards the closing part of it. If somebody's listening to this session and if there are only one or two things they can do, simple habits to improve their borrowing power, be it they're buying their first home or investor or SMSF or something like that. What are the one or two things, simple things that they should do or start considering?
What I had to learn myself as well as a young person, very much affected by the power of having a credit card and being young, wanting to buy new shoes and bags, is also know yourself. How do you earn money and how do you like to spend money? And what I actually did for myself is I invested before I spent. So all the
Mm,
money that came in, all the direct deductions happened, then only I was spending for my day to day living. So I am not the best saver myself, but also I'm a very good planner. So
mm,
understanding your habits,
mhm,
what ticks you, what works for you. I would also like to introduce there is a app called Raise, RAIZ, for
mm,
people who don't like to, save for that grocery or something, but they might want to go out and even just have 5 dinners with the family every month.
mm,
The best way, if you have a budget, is go on to Raise and then set yourself a goal of $500 or $1,000 a month, and then it actually debits your bank account. So every time you buy, let's say groceries of say $30, 50 cents, it will
mm,
take $20 and put it into Raise, and it gets invested. Whenever you
mm,
need the money, you can actually bring it back into your account. So
mm,
look at your habits. Who are you? How do you like to spend? How do you like to have money? A lot of people like to see money in their account, but they don't invest it. I would
mm,
highly recommend. Money in an account is actually dead money. It should
mm.
either be invested or spent on your joy.
Phenomenal, phenomenal. That's a great, great advice. Thank you, Madhu. It's been absolutely rewarding. It's always been 1 hour. I didn't even realize that it has gone that much time. But thank you for your time and all of the valuable insights.
And I think that people should not overthink that they can't do. Talk to, a couple of brokers, talk to a couple of accountants, understand who's a good fit for you.
Mm.
Start with advice and start with the structure.
Thank you, Madhu. Really have enjoyed this session.
Same
Thank you
here.
for all of your valuable inputs.
And we look forward to working together.
All right. Thank you.